Welcome to Stock Wars. This battle between dividend stock combatants will determine who seizes interstellar domination and is the most attractive railroad going forward. The first Stock Wars combatant is Norfolk Southern. Norfolk Southern is one of the nation's premier transportation companies. The railway company operates approximately 19,300 route miles in 22 states and the District of Columbia, serves every major container port in the eastern United States, and provides efficient connections to other rail carriers. Norfolk Southern is a major transporter of industrial products including agriculture, forest and consumer products, chemicals, and metals and construction materials. In addition, the railroad operates the most extensive intermodal network in the east of the U.S. and is a principal carrier of coal, automobiles, and automotive parts. The second Stock Wars combatant is Union Pacific. Union Pacific engages in the railroad business in the United States. The company was founded in 1862 and is headquartered in Omaha, Nebraska. The rail network includes 32,313 route miles connecting the Pacific Coast and the Gulf Coast ports with the Midwest and Eastern United States gateways. The company offers transportation services for nearly every conceivable product. Let the battle begin! Choo-choo! Norfolk Southern is currently trading at $274.63 and is up over 93% in the last year. Over the last 5 years, Norfolk Southern is up over 226%. Union Pacific, our other railroad titan, which is trading at $223.47, is up over 61% in the last year. With that said, Union Pacific is up over 179% during the last 5 years. Now let's take a look at which combatant may perform better going forward based on its current valuation. The first item to compare is market cap. Market capitalization, commonly called market cap, is the market value of a publicly traded company's outstanding shares. Market capitalization is equal to the share price multiplied by the number of shares outstanding. Market cap is probably the least important metric in Stock Wars, but it is an indicator of public opinion of a company's net worth and is a determining factor in some forms of stock valuation. From a market cap perspective, Union Pacific is the larger company with $147 billion compared to $68 billion for Norfolk Southern. Both are railroad favorites, but Union Pacific takes the first metric comparison in this Stock Wars battle with $79 billion more in market cap. The second Stock Wars metric comparison is revenue. Revenue is the income generated from normal business operations. It is the top line or gross income figure from which costs are subtracted to determine net income. Who generates more revenue in this epic Stock Wars showdown? In 2020, Norfolk Southern had $11.2 billion in revenue, while Union Pacific came in at $21.7 billion. Union Pacific wins the second consecutive metric in this battle against Norfolk Southern. The third metric comparison in Stock Wars is further down on the income statement. Net income or profit. Profit describes the financial benefit realized when revenues generated from a business activity exceeds the expenses, costs, and taxes involved in sustaining the activity in question. For the third metric in this Stock Wars battle, Union Pacific takes the win with $5.91 billion in profit, while Norfolk Southern came in at $2.71 billion. Union Pacific has now won the first three metrics in this epic Stock Wars battle. Knowing the profit for each combatant transitions into the next metric in this Stock Wars comparison: profit margin. Profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or a business activity makes money. It represents what percentage of sales have turned into profits. Norfolk Southern comes in with a profit margin of 24.19%, while Union Pacific is at 27.23%. For the fourth metric in a row, Union Pacific wins. Both corporations have decent profit margins in a fairly competitive industry. As the stock wars rage and Union Pacific maintains a 4-0 lead in this battle, the fifth metric is in sight: 3-year revenue growth. Revenue growth illustrates sales increases or decreases over time. It is used to measure how fast a company is expanding or contracting. Norfolk Southern comes in with a 3-year revenue growth of 8.4%, while Union Pacific wins a fifth metric in a row with a 3-year revenue increase of 8.8%. As the two railroad titans battle for supremacy, P/E ratio emerges as the sixth metric in this stock wars battle. The price-to-earnings ratio is the ratio for valuing a company that measures its current share price relative to its per-share earnings. The price-to-earnings ratio is sometimes known as the price multiple or the earnings multiple. When examining the forward P/E, Norfolk Southern comes in with a metric of 24.21, while Union Pacific boasts a forward P/E of 22.88. Union Pacific comes out on top for the sixth time in this stock wars matchup. As the battle rages between these railroad juggernauts, dividend yield is the next metric comparison in stock wars. The dividend yield, expressed as a percentage, is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. Norfolk Southern comes in with a low dividend yield of 1.46%. Union Pacific, on the other hand, is at a higher 1.76% yield. For the seventh time, Union Pacific wins a stock wars metric. Both yields are relatively conservative. Continuing on, the next metric is years of consecutive dividend increases. Companies with a track record of dividend increases tend to be more stable and motivated to maintain that track record. When analyzing the two combatants, Norfolk Southern boasts 19 years of dividend growth, while Union Pacific comes in with 15 years of consecutive increases. In this metrics battle of railroad monsters, Norfolk Southern comes out on top. Now on to the 5-year dividend growth, which is the next metric in this stock wars battle between these railroad leaders. The dividend growth rate is the annualized percentage rate of growth that a particular stock's dividend undergoes over a period of time. Many mature companies seek to increase their dividends paid to their investors on a regular basis. According to Fidelity, Norfolk Southern has a 5-year dividend growth rate of 9.76% compared to Union Pacific at 12.02%. Union Pacific claims the metric in this stock wars matchup. This begs the question for our next metric: how safe are the dividends? The Dividend Safety score system takes into account more than a dozen fundamental metrics that influence a company's ability to continue paying dividends. According to Simply Safe Dividends, Norfolk Southern has a score of 86, which is considered very safe. On the other side of the matchup, Union Pacific has a score of 88, which is also considered very safe. Union Pacific is the victor of this stock wars metric. The 11th metric in the stock wars contest also reflects on dividend safety: the payout ratio. The payout ratio is a financial metric showing the proportion of earnings a company pays shareholders in the form of dividends. This is expressed as a percentage of a company's total earnings. Currently, Norfolk Southern's payout ratio is 50.51%, while Union Pacific is at 49.24%. Both payout ratios are excellent, but Union Pacific is the winner of this stock wars metric. Moving on quickly to the 12th metric, the two railroad giants will compare current ratios. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. It tells investors and analysts how a company can maximize the current assets on the balance sheet to satisfy its current debt and other payables. Norfolk Southern clocks in with a current ratio of 1.07, Union Pacific, on the other hand, sees their current ratio at 1.01. The higher the current ratio, the better. Therefore, Norfolk Southern takes the Stock Wars metric with a slightly higher current ratio. The last metric is the debt-to-equity ratio in this Stock Wars contest. The debt-to-equity ratio is calculated by dividing a company's total liabilities by its shareholder equity. These numbers are available on the balance sheet of the company's financial statements. Norfolk Southern sees a debt-to-equity ratio of 0.89, and Union Pacific comes in at 1.67. While both are well over 0.5, which means their assets are financed by debt, Norfolk Southern gets the better of this metric and wins another one. In this Stock Wars battle, Union Pacific won 10 metrics compared to Norfolk Southern, who won 3. Union Pacific is the decisive winner of this epic Stock Wars battle of railroad favorites. Union Pacific wins the overall Stock Wars battle from a metric standpoint in what is the biggest blowout in Stock Wars to date. That being said, both companies are overvalued at their current prices, and you should make a decision based on your investing objectives. If you missed one of the first 6 episodes of Stock Wars matchups, please check them out and let me know what you think. I'll leave a link in the description. Stay tuned for future Stock Wars episodes, and please like, subscribe, and turn on the bell notification so you don't miss any other future episodes. Comment below if there's a particular battle you'd like to see. Until next time, remember, I am not a financial advisor. The opinions expressed in this video are solely for educational and entertainment purposes. Any stock purchases I show on video should not be considered an investment recommendation. Investing involves risk, and you should do your own research. For investment advice, please seek the counsel of a financial investment advisor.